Hi there. Thanks for tuning in. Today we're going to be doing an analysis and valuation of Pax Global. This was a viewer request, so I found it a very interesting stock to analyze, and I can't wait to share the results with you. But first of all, if you like these kinds of videos, it would help me a lot if you liked, subscribed, and hit that notification button. I love responding to viewer requests as well, so comment down below if there's any stocks you want me to look at from a value investing perspective. And I just appreciate all the help and all the views and all the great comments. With that said, let's keep going. Let's talk about Pax Global. So first of all, they are a point of sale company. They sell these little terminals where if I'm a vendor and I'm selling something, you hit your card or phone nowadays with this and you pay me. Right. So here, it's very interesting how they presented this chart where the gross profit margin is here first and you're like, "Oh, it's improving." And then you see the revenue chart, and then you see the profit chart, and you realize that all is not what it seems. So yeah, they're profitable. They have good margins, but the revenue is decreasing so much, and so is the profit. So what's going on here exactly? And you're pairing this too with they're talking about your shareholder returns, where they have a dividend of 25 cents in Hong Kong dollars per share and a dividend payout ratio of 67.8%. So you see that the dividend is growing, but so is the payout ratio. I mean, it's very interesting because it went from a payout ratio that wasn't risky at all over here, 10%. Or no, wait, because the graph is weird, 25%, there we go, to now almost 70%. So that's very interesting. And that makes me it shows us that the declining profits actually could affect your shareholder returns eventually if they keep declining. So far, I mean, it's an amazing dividend so far, but is it just what you want? Do you just want the dividend? Because then if it's in risk and they cut it, you could just lose the majority of your gains there. So that's something important to note. And surprisingly, they do buy back shares actually. They don't issue any shares, they're buying back a ton. So you do have shareholder returns being shown there just from what they're doing with their extra cash, with their free cash, which is positive. They also have a lot of global diversification. So there's Latin America, where they say they have sluggish sales due to economic uncertainty, currency fluctuation, and market competition. You also have US and Canada. You have Asia Pacific and Europe and Middle East. So you do have all these adoptions in retail. You have their Android system, which is very, very helpful. And you have things like growth in Japan, growth in Australia. So that's pretty great. At least they have that global diversification pie there, which is super, super important. But at the same time, you do see threats here and there to a bunch of systems, and maybe Africa actually turns out to have a little more potential than more developed places that have those sort of already existing systems. And I'll talk about them in a little bit. I also want to look at their long-term profile where you can see that they had monstrous growth all the way through 2022, double digits we're talking, and then all of a sudden they started taking a hit, negative 17%, negative 9.5%. So if they can turn it around, they'll do amazingly, of course. You can also see here that the gross margins have always been very consistent. The operating margins, albeit declining a little bit from where they started, but still very solid. And their return on invested capital also declined a little bit, but looks okay at the very least. So financially, they look sound. They don't have debt either. They don't really do much stock-based compensation either, so they're cash flow positive. We love to see that. But it's interesting because not everything is clear cut. It's a declining revenue company and it may have declining market share. So we have to treat it as such. But first, let's do a model. And this is a discounted cash flow model. It's in Hong Kong dollars. And what I'm doing here is simply forecasting a decline in free cash flow and then a slow recovery. And that's either going to be because margins improve or because the revenue growth improves again. But either way, we'll see on what the recovery looks like, but it's not going to be at the same level of free cash flow that they had in 2024. It's closer to that level they had in 2023. That sounds a little more realistic. And then just a recovery, either from becoming more efficient or growing again. then my required rate of return is 11%. My perpetual growth rate is going to be 3%. I'm going to say they're going to grow in 3% in perpetuity. And I'm going to divide that by the total number of shares out to get a fair value of $7.47. But they have a net cash position actually. So if we add that net cash position or subtract that negative number of debt, we actually have a little more value here, where it's 7 Hong Kong dollars and 85 cents. But because there's country risk, let's apply a 20% margin of safety from $7.85. Now, there's two ways to do this. One of them is I could simply go here and move up my required rate of return. Oftentimes, you can do that by comparing sort of the bond spread or the equity risk premium. What I'm going to do here is a little more simple. It's a little more just saying, hey, here's my what I think is a fair valuation. I'm going to just grab 20% and just chop it by that. So that 7.85 times zero point 0.8 basically is going to be $6.28 in Hong Kong dollars. This is my new fair value to account for country risk. And let's compare it to the actual value right now, which is $5.89. So it is slightly undervalued. And if you look in the last 5 years or so, well, it's not moved that much. And so liquidity is something to note, but theoretically it's undervalued and it's been above this before, not by much though. And that's important to note. Now, what I see is that there's some risk and some reward here. So the liquidity looks low, so be ready to wait. If in 5 years it never even moved to that six level, well, you may be in here for the very long haul. But believe it or not, you get a nice dividend paired with share buybacks to wait and no debt, which sweetens the deal. At least, even if their profits are declining, they can still use those profits to pay shareholders or to figure out how to grow again rather than paying interest on debt. However, the dividends aren't risk free. If they're cut, you're going to see something very, very ugly in terms of the share price. And the competition is fierce. The moat may really not be there. And I'm giving the example of Pix and Mercado Pago. So, for example, in Latin America, which a lot of companies always say is such a high growth zone. It always will be, almost never is, right? This, they have payment systems like the Pix in Brazil, where it's sponsored by the government, basically. And I don't even interact with a point of sale system when I'm in Brazil, because if you have a Pix, all you do is just give them your number and do the payment through there, and that's it. Almost everyone uses Pix now. And in Argentina and a couple other countries, you have Mercado Pago, for example, which does a very similar function, and you're not even going through any point of sale terminal. So that's very important to note. However, there is sometimes winners that come out of these sectors with declining market share. So, can they consolidate a smaller portion of the market share? If you look at Cinemark, for example, they were able to very successfully consolidate the market share of cinemas, to keep cinemas in the most profitable areas, to buy out certain cinemas and sort of consolidate that declining industry. So, you would think that Cinemark stock has done really badly, but if you look at it, it's really not a bad performer. Can they do that? Well, it's all going to be in the execution. It's all going to be in their plans for the future. And it's going to require a lot of diligence, especially if it's in a situation like this where the liquidity looks very low, where the undervaluation is up by that much, really. It's only like a 5 to 7% undervalued, according to my model. So you just have to do the risk reward here. Would you sleep just fine knowing that your money will be locked into the stock for a certain amount of time? And because it's in Hong Kong, if you're not a Hong Kong based investor or have ready access to it, it may be locked in for even longer because then you'll get certain fees associated to buying it. So those are all things to consider. The opportunities on there are there, but can they execute, right? The opportunity is either you get back to profitability somehow and get back to growth, or you consolidate that reduced market share. Can they truly execute? Well, that's where the risk really is, in how much you can believe they will execute this and how well you're going to sleep at night knowing that you're invested in this. Now, thank you so much for watching once again. If you liked this video, don't forget to drop a like. Thank you once again for your time, and please enjoy your day.